New tax brackets and savings limits have been announced. What do you need to know when stashing those Benjamins and prepping your taxes? We'll share.
Hello, darlings. And now it's time for your favorite part of the show, our Stacking Benjamin's headlines.
Well, every year we find that the tax brackets change and the amount you can save has been revealed. Of course, I'm talking about saving into things like Roth IRAs, your 401k, 457, 403b. Everybody is, of course, now turning to preparing your taxes in 2025. And there are going to be adjustments in more than 60 tax provisions. But of course, the two big ones we're focused on here at Stacking Benjamins are, number one, the changes to the tax brackets. And then number two is, of course, the amount that you can save into these different places. How important is it, OG? We'll link to these actual numbers. I'm not going to read these. I'm not going to read these tables. Here's the tax table. That's good audio.
From zero to $12,105 if you're
filing single. OG, what I really want to focus on is, what is it about the tax brackets you think we really need to know? Like, just conceptually, what do we need to know about tax brackets that either A, people don't think about enough, or B, people just plain might get wrong?
Well, I think there's two things here. Firstly is, maybe there's even more. The first thing that comes to mind is the concept of marginal rates. And for some reason, we just haven't quite grasped this yet as a society. It's like, I don't want to earn this much because then I'll be in the 32% bracket. It's like, okay, but that's okay. I mean, it's better to have more than not more in most cases. And by the way, it's marginal. So what that means is that it's just that extra dollar that goes into that bracket. So if you're like, oh my gosh, I made an extra $5, I'm in the 12% bracket, or I'm in the 30%, like whatever that is, it's just that extra dollar that's taxed at that higher rate, not all the rest of the money. And I think for some reason we kind of miss out on that. That's probably the first realization that I think would be helpful. The second thing around savings and investing is that it doesn't take a lot of time, but I believe if you haven't sat down and done the math on your saving, let's say that you're maxing out your 401k or you're going to max out your Roth this year, it requires you to make a little bit of a change, to get that number evenly distributed. If that's your plan, if your plan is, I'm going to put the same amount in every paycheck to get there, or the same amount every month to get to my Roth max or whatever. You have to make that change to account for the fact that it's gone up a little bit. It went up with IRA contributions. It went up with your 401k. It went up with your HSA by a little bit. So like all of these require like little tweaks, unless your income is so high that you can put a percentage in and still max it out. But in most cases, you still want to spread it out throughout the whole year, unless your company is for sure doing a what's called a true up in your 401k. Because a lot of companies, if you stop putting money in, they stop putting money in. So if you're like, I got a big bonus in February, I'm going to take all that money and put it in my 401k right now. If your company doesn't do a true up at the end of the year, you're going to miss out on all that contribution that you would have gotten had you distributed it evenly throughout the year. So I think it just takes a little bit of time so that there's not a surprise, at the end of the year. But statistically, if you do have the cash, and I know a lot of people get excited about this, which is cool. If you do have the cash, you can do all the money in your Roth IRA right now. You can put all the money in your HSA right now. You can put all the money in your 401k right now if your company does that calculation, like I mentioned. And, statistically, you're still dollar cost averaging. You're just doing it on an annual basis, not on a weekly or monthly basis. So don't let that dissuade you. And, you get the whole year of that money invested, which, in theory makes it worth more. I like the idea of simplicity. We have a friend, Joe, you and I have a friend who on the first of every year pays all of his bills in advance for a year. Like He sits down and goes, here's how much I know that I paid the electrical company last year, $500 a month. I paid him $6,000. I'm writing them a check today for $6,000. So I don't have to, there's no mental energy expended in doing that. And I know a lot of people are going, wait a second, that's ridiculous. Letting the water company or letting the, electrical company or letting your mortgage, he doesn't have a mortgage, but you get the idea. Letting all these places hold on to your money for a year. And in his mind, the stress of not having to pay bills for the whole year is way better than the stress of like, oh my gosh, I'm going to lose out on $600 of interest, you know? So if you can simplify things, if you can make it from a decision standpoint, you know, that I think that's super helpful. Back to the taxes. People get stressed out about taxes. Don't. It's just a calculation. I think the best time to do your tax calculation is going to be in the third quarter. Wait for the year to kind of start getting going. Now's not the time to, I mean, you can do it, but I wouldn't put a lot of energy in trying to plan your tax strategy for 2025 right now. Let the year happen. Get into July, get into August, see where you're at, see how your job situation looks like. Maybe you got a pay raise, maybe you got a bonus. You can sit down on the IRS website and do some calculations. It still gives you 5 or 6 months to catch up, you know, if you're a little behind. That's how I think about it anyway. Knock out the big decisions that you can do once. Don't worry about marginal brackets, and do an in-depth calculation maybe first of August.
Your bias when it comes to saving, and we'll get to how savings rates have changed in 2025, because they have, not in every type of account, but they have in some, that I think is going to excite some of our stackers. But is your bias toward pre-tax or the Roth, just generally?
Yeah. Yep. That is my bias. Correct. My bias is yes.
Your bias is all the above.
My bias is saving. I mean, here's the thing. There's no way to predict what the future tax rates are going to be. And for the last 25 years... Well, that's why
my bias is toward the Roth, OG, is just that one statement right there.
I got it. I understand that completely. And I would also submit to you, for the last 25 years, we've been told, you know, that the economy and there's obligations and Social Security is going to force more taxation, blah, 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 blah. I don't know this for a fact. And I could probably, somebody can go back and fact check this. I don't know that tax rates have manifestly changed in the last 25 years that I've been doing this. Do you think that they have? I don't know. It doesn't seem like they have. They definitely ebb and flow, and there's good, you know, depend on whose, you know, administration it is. But I don't know that, you know, we're sitting here with staring down the barrel of a 50% tax rate at some point in time, because they've been saying it for 25 years. That doesn't mean it's not going to happen, but there's some reasons to do pre-tax. For example, your FAFSA contributions, if you have to do a FAFSA, pre-tax 401k contributions help you on the FAFSA. Roth 401k contributions do not. I don't know why. It seems pretty stupid to me, but
maybe it's because with the Roth, you can get at that money. So they're saying, hey, this money's gettable.
I mean, everything's gettable, I suppose, at some level. Anyways, I think there's more to it between pre-tax and Roth than that. And what I'd prefer to see is a pretty reasonable distribution between the three different buckets, right? Pre-tax money, after-tax money, and Roth money, tax-free money. And the more you have in an evenly distributed bucket, the more that you can arbitrage that when it comes time to take that money out. See, the big play with pre-tax and Roth is, if I can pay taxes today, it's basically the timing of the taxation, right? If I can say with a high degree of certainty that I'm going to be able to take this money and pay a lower tax rate in the future, or I'm going to pay a low tax rate today as opposed to the future, you know, that's the gamble that you're making. But if you have some flexibility there, let's say that you have a bunch of money in pre-tax, a bunch of money in Roth, and a bunch of money in after-tax. Now, when it comes time for your distribution in retirement, you can play the game of going, oh, well, I'm going to take some of my money from this bucket at 12%. I'm going to guarantee that I'm getting the low tax rate on this, versus trying to guess on what's going to happen. So given the opportunity, I'd probably diversify it to make sure that we've got some balance. But you'll be plenty wealthy with $10 million in your IRA and $10 million in your Roth. Nobody's going to complain about either of those things.
The thing I like about that argument is the fact that I think a lot of people play this game, not really a game, but they think about this as if it's an either or discussion. It doesn't have to be either or. It can be and, right? You look at the nature of improv, and how improv is yes and this. And the fact that I think that you can do both surprises a lot of people. And this isn't just around IRA contributions, 401k contributions, TSP, whatever it might be. This is around a lot of financial decisions in life. The answer can be and.
Well, think about the person who's planning an earlier retirement, let's say in their mid-50s, you know, and you're 45 today, and you're saying, well, isn't it better to put money in my 401k and just take it out of my paycheck. It's like, well, maybe for you, it would be better to have a little bit more money after tax, because you're going to need some flexibility in your distribution timing for the first, 8-10 years of retirement, or you're planning on taking Social Security at 70, not at 62 when you retire, and you're going to need 8 years of living expenses. It's a very personal decision in terms of how you map it out. And the interesting thing about financial planning, of course, is that just because you did it right, did it today, life's not going to be a straight line. There's going to be changes that happen in the next 5 or 10 years, whether it's tax rate changes or your personal situation or the economy or whatever. So it's an ongoing, debate and change. We've changed our contributions in our life from pre-tax to Roth and back and forth year after year, largely just to kind of keep that balance the way that I want it, so that I've got the flexibility when it comes time for distribution. And for the first 20 years of my life, I didn't have, an option for a 401k, a Roth 401k. So it was like literally trying to play catch up. And now that we've kind of caught up again, now I'm just trying to balance it out, because the employer matching contributions are traditional or, pre-tax. So, you know what I mean? Like, we change it year to year, and there's no right or wrong answer to any of this. If you save, $70,000 a year in your accounts, if you're married and you can both participate in 401ks and HSAs and Roths, it's like, it doesn't much matter where the money goes as long as it's invested.
If you want to see the tax control triangle that OG is referencing and keeping some balance in the different types of accounts that you have, you'll find that at stackingbenjamins.com/tax triangle. And we have that there, and it's free. So take advantage of that resource if you're still a little confused about how that works. But it very much is once you grasp that we're looking at taking a bird in the hand today and giving yourself flexibility for the future is really what that tax control triangle is all about. More good news, by the way, for people with a 401k, a 403b, TSP, most of the 457 plans, most of the plans out there historically last year in 2024 allowed you to put in $23,000. Those plans went up at the beginning of 2025. You can now put in $23,500. So OG, to your point, you just want to change your automatic investments if you can afford to do that and put the max in. Yeah. You've got an extra $500 this year. Now, that's not the case, though, for IRAs. IRAs were $7,000 last year, and they stayed the same this year.
Dun,
so,
dun, dun, dun.
Yeah. Why one went up and the other didn't, OG, is beyond me. There's some calculation going on that might be above my pay grade.
You think that somebody did some calculations on that? Oh, that's nice.
Wait, you think they actually thought about it? Does that deserve one of those?
Right.
Yeah.
Yep, exactly.
Head to our show notes and we'll have all of these numbers for you. stackingbenjamins.com. Scroll down to the show notes for today's show, and you will see all of the numbers when it comes to this year's tax brackets and saving opportunities. And not only that, but wait, there's more. OG's firm has put together a list of all the changes, basically all the important tax information you need to know, OG.
Yeah, we'll send this to anybody that's on the 201. So if you don't get the 201, sign up for it, and we'll send it to everybody. But it's basically all the stuff that you're just talking about, Joe, the tax brackets, the standard deduction information, Social Security information, Medicare premiums and IRMA surcharges, and capital gains tax rates and RMD tables and catch-up contribution, like all of the data in terms of where are these numbers at? Basically, it's the 2025 important numbers PDF. So 2-pager, we'll send it to you. Just sign up for 201. We'll send it in an email. We're
going to send it on Friday. So if you're listening to this before Friday, sign up for the 201, stackingbenjamins.com/201 for that special edition. And if you're listening to this after Friday, just send me an email, joe@stackingbenjamins.com, and I'll make sure that we get it to you as soon as you write to us. So happy to do that.